John McLeod, a collateral policy senior, and Stacy Nolan, a credit policy risk manager. In a few moments, you'll get the chance to meet them and hear more about their topics. In this session, Ellie will present guide and policy updates in manufactured housing. John will walk us through some important points in single-wide units, and Stacy will bring us up to date on the latest in affordable seconds. As we kick off this new webinar series, I'd like to share with everyone the goals that we set out to accomplish along the way. To give concise overviews of critical policy changes, to provide transparency into the reasoning behind those policy changes, and to share best practices, examples, and expert insight into what these changes mean for you. Now let's meet the team.
Thanks, Jessica, and hello, everyone. My name is Ellie Mirmirani, and I am an Affordable Credit Risk Policy Senior. I have been with Freddie Mac for the past 15 years, and I've held various positions since. Currently, I'm responsible for developing policies and terms of business in the affordable area, and I have mainly worked on manufactured home policies. And now I will turn it over to my colleague, John McLeod.
Thanks, Ellie, and hello, everyone. I'm John McLeod. I'm a senior policy manager in Freddie Mac's collateral policy section, and I've been with Freddie Mac for 5 years. My responsibilities include policy and TOB development for collateral-related topics. I'll now turn this over to Stacy. Thank you.
Hi, everyone. My name is Stacy Nolan, and I'm a credit risk policy manager on the Affordable Credit Policy team. I worked in the primary market as a regional operations manager and underwriter for 16 years prior to joining Freddie Mac in 2008. Since joining Freddie Mac, I've worked in the single-family division in various positions in quality control, quality assurance, business management, credit policy, and credit management. Jessica, over to you.
Thanks, Stacy, and thank you to everyone for taking time out of your busy day to join us. Ellie, let's get back to you to get us started with manufactured homes.
Thanks, Jessica. Today, I'm going to start us off by providing you with some recent updates to our manufactured home policies. The first policy I will review with you today is manufactured homes with affordable seconds. This policy was published with our July bulletin last year. Previously, our guide did not specifically address the eligibility of manufactured homes with affordable seconds. To provide clarification regarding the requirements for these mortgages, we have added language to this section of the guide, specifying the criteria that these mortgages must meet for delivery to Freddie Mac. The update requires that to be eligible, a manufactured home must comply with the requirements of Chapter 5703, which is our manufactured home chapter, and it must be a one-unit primary residence. The mortgage must be a home possible mortgage that meets the requirements of Chapter 4501, which is our home possible mortgage. And if the manufactured home is in a condominium project, the project must meet the requirements of Section 5705.1. We have also added a statement in our Section 4204.2, our affordable seconds, which refers back to the updated Section 5703.3.
That's a great guide update. What can you tell us about the leasehold estate updates?
So allowing purchase of mortgages secured by manufactured homes on leasehold estates was another policy that we introduced last year. By introducing this policy, we have strengthened our support of low to moderate income home buyers, support of our duty to serve initiative, and affordable housing supply. The requirements for this policy can be found in our guide chapter 5706. Sellers must obtain a prior written approval to sell mortgages secured by manufactured home on leasehold estates to Freddie Mac.
Can you give us an overview of the eligibility requirements?
Of course. So to be eligible for purchase by Freddie Mac, a manufactured home on a leasehold estate must be a one-unit dwelling, primary residence, and a multi-wide unit. It must be located on a leasehold estate and must meet all the requirements of Chapter 5704 and also located in a ground lease community. If it is located in a condo project or pod, sellers must also comply with the condo project or pod requirements. All mortgages secured by manufactured homes on leasehold estates must be LPA exempt mortgages. So manually underwritten mortgages are not eligible for sale. We only allow purchase transaction and no cash out refinance mortgages. And the maximum LTV, TLTV, and HTLTV is 95% for these mortgages. We are aware of titling issues in some states and require that the manufactured home on a leasehold estate must be located in a state that permits surrender of certificate of title. We also require title insurance, and we do not accept an attorney's opinion of title in lieu of title insurance policy.
Thank you. Attendees, please check the chat box for a question to consider while Ellie explains the new LTV calculation for manufactured homes in subdivisions.
Yeah, so the manufactured home subdivision LTV calculation was introduced in February of 2023. We have expanded our requirements for calculating the loan to value on purchase transaction mortgages secured by existing manufactured homes. The new LTV calculation for manufactured homes located in a manufactured home subdivision that is sold by a builder or a developer is based on the lower of the purchase price of the manufactured home and land or the current appraised value of the manufactured home and land. With this expansion, we have eliminated the seasoning requirement for the manufactured home to be affixed to a permanent foundation 12 months prior to the application receipt date. This policy applies to existing manufactured homes, which means that the manufactured home must have already been affixed to the permanent foundation, and it only applies to purchase transaction mortgages.
Thank you, Ellie. And can you tell us the correct answer to the chat question?
So if you answered yes to the chat question, you are correct. In addition to the requirements in section 5704.1, the lease must also provide that subleasing is allowed if the leasehold mortgagee or its designee takes title to the manufactured home and the leasehold estate.
There have also been changes to choice home requirements. Can you walk us through those updates?
Of course. So previously, sellers were required to obtain written approval before selling mortgages secured by a choice home to Freddie Mac. To provide our sellers with additional flexibility, we have updated section 5703.9 to eliminate this requirement. What is a choice home? A choice home is a type of manufactured home with architectural elements and dwelling specifications that exceeds the minimum standards required for hot-coded manufactured homes. These properties have features comparable to conventional or site-built properties. To be eligible for these mortgages, the mortgage must be a purchase transaction or a no cash out refinance, and it must be secured by a one-unit primary residence that is a choice home. The mortgage must be a fixed rate or a 5/6, 7/6, or 10/6 month ARM. Home Possible and Home One mortgages must be fixed rate mortgages, and they must meet the property requirements for a manufactured home. This policy applies only to multi-wide manufactured homes. And we have different LTV, TLTV, and HTLTV requirements for choice home based on product and mortgage term. So I encourage everybody to refer to guide section 5703.9 for additional details. A mortgage that is secured by a choice home with an LTV greater than 95%, but less than or equal to 97% is eligible for mortgage insurance. Sellers should submit a mortgage with an LTV ratio between 95 and 97% to an MI company to verify that the MI company provides this coverage.
Thank you, Ellie. And if everyone could please check the chat box again for a poll question, we would really love to hear from you on this topic.
So we are also doing some additional work in the manufactured housing space. We are adding flexibilities on cash out refinance mortgages for manufactured homes when the purpose of cash out refinance is to combine the land and the manufactured home into a real property. And we're also introducing additional flexibilities on title seasoning requirements for cash out refinance mortgages secured by a manufactured home. Both these policies will be published with our September bulletin. We are also very excited to let you know that we are reorganizing our Chapter 5703, which is our manufactured home chapter, to provide you with a client-friendly format, and we will give Choice Home its own dedicated chapter. This will be a total transformation of Chapter 5703, so we would love to hear from you to see which areas of this chapter are your possible pain points and which areas you would like to see most improved. And also, if you have any additional suggestions on how we can better help you understand our manufactured home requirements, please add them to the chatter.
Great, thank you, Ellie. We'll now pause and ask you a few questions. Just a reminder for our audience members, if you have any questions for Ellie or any of our speakers today, please enter them in the Q&A box located in the bottom right-hand corner of your screen. Please refrain from submitting them through the chat if you can, but first question for you, Ellie, today is, can a manufactured home on a leasehold include an ADU?
No, a manufactured home on leasehold estates must not include an ADU.
Okay, great. Next question for you, Ellie, is cash out refinance allowed for manufactured homes on leasehold? If yes, what is the cash disbursement?
Cash out refinance is actually not allowed for manufactured home on leasehold estates. We only allow no cash out refinance and purchase transaction. And for no cash out refinance, the disbursement amount is up to the greater of 1% of the new refinance mortgage, or $2,000.
Great, thank you. All right, last one we have for you, Ellie, is some language in the manufactured home chapter of the guide is a little hard to understand. Are you planning to update the language when you update the chapter, or are you only planning to reorganize the sections?
Yes, thank you for the question. And yes, we are aware of the ambiguity in some areas of Chapter 5703, and we will be addressing those with our updates. But if there is a specific section or paragraph that you have in mind, please let us know, and we will make sure that we will review those and revise the paragraph.
Those were great questions. Let's catch up with John for updates in single wide units.
Thanks, Jessica, and hello again to our attendees. Today, I'll be discussing recent policy updates made to the Manufactured Home Chapter 5703 of our Seller Servicer Guide that were published in Bulletin 2023-13 on June 6th of 2023. First, let me provide a little background. Back on November 14th, 2021, Freddie Mac offered sellers a guide term that required approval from Freddie Mac that made single-wide manufactured homes located outside of a condominium project or a PUD an eligible property type to secure a mortgage sold to Freddie Mac, provided the mortgage manufactured home was 10 years of age or less on the appraisal's effective date. Many sellers did request authorization to adopt this offering. One challenge associated with the 10-year age restriction was the fact that it prevented the homeowners from being able to refinance after the property was more than 10 years old. This restriction also excluded many units that could meet Freddie Mac's guide requirements for condition, marketability, and quality of construction. So upon further analysis, Freddie Mac has decided to retire the guide term and its age restriction and revise guide's policy to remove the restriction that a single-wide manufactured home must be 10 years old or newer as of the appraisal's effective date.
Thanks, John. Can you walk us through these property requirements?
Of course. Consistent with our existing manufactured home policy, single wides must have been built on or after June 15th of 1976, with evidence of HUD code compliance, be attached to a permanent foundation, and be legally classified as real property. Also, specific to single wide units, we only purchase and no cash out transactions are allowed, and only for the borrower's primary residence. To ensure sellers have time to operationalize these changes, the effective date for the policy is delayed until September 11th of 2023. Just to follow up, all cash out transactions are ineligible, and the mortgage must be secured by a single wide manufactured home. And additionally, any mortgage secured by a single wide manufactured home with an LPA status other than accept would not be eligible. As a reminder, this policy is applicable only to single wide units that are HUD coded and are not leasehold.
For our attendees, please check the chat for a question regarding HUD labels while John details the appraisal photo requirements.
Thank you. Appraisal reports prepared on or after September 11th of 2023 must include photos of the HUD label and data plate to verify the manufactured home, both multi-wide and single-wide, have evidence of HUD compliance. The HUD label, also known as the tag, is attached to the exterior of the manufactured home. It certifies the unit was manufactured in accordance with the HUD code. The only information specific to the unit to which it is attached is the label number. On the other hand, the data plate, which is located inside the unit, usually near the electrical box or under the kitchen sink cabinet, includes significant information that is needed by the appraiser to complete the valuation assignment. The information included on this tag include the name of the manufacturer, the address of the manufacturing plant, the serial model number for the unit, the model name, the date of manufacture, wind zone, snow load, and roof load information.
And what about the answer to our chat question?
Well, I was wondering when you'd get to that one, and I'll tell you the answer to our chat question is no. In order to be eligible, Freddie Mac requires that both exhibits be present.
Thank you. And what if the HUD tag is missing? How can the owner get a copy?
Well, we have a way of doing that. If the certification label, also known as the tag, is missing from the home, HUD does not reissue labels for manufactured homes. However, they can issue a letter of label verification for units for which they can locate a history in their database. The label numbers can also be found on the data plate inside the home. And again, it could be located near the main electrical box, in a kitchen cabinet, or in a bedroom closet. And then there is an option to obtain a letter of verbal verification from the Institute of Building Technology and Safety, IBTS. And there are contact numbers and email addresses to be able to contact that entity.
Thank you, John. And John's final update for us today is cost approach.
Again, thanks, Jessica. The cost approach is in guide section 5703.6 as it applies to manufactured homes. And a well-developed cost approach is required for all manufactured home appraisal reports. This approach to value requires the appraiser to support the construction of quality rating that they use. Freddie Mac has Exhibit 36, and it provides supportable definitions for property condition and quality ratings, which an appraiser can use. The use of these ratings for condition and quality can help remove subjective terms from the appraisal report. Additionally, like site-built dwellings, not all manufactured homes are constructed using the same quality materials and finish. So to address these differences, appraiser can again rely on Exhibit 36 to provide support for adjustments made to address property quality of construction differences.
All righty, John. Now we have a few questions for you. Just a reminder again for anyone in the audience who have questions for our speakers to enter them into the Q&A chat, and we will try to answer as many as we can on air today. But the first question I have for you, John, is the cost approach required for all manufactured home appraisals?
Yeah, I can tell you with great certainty, all manufactured home appraisal reports must include a detailed cost approach that's based on data from the market, from cost services, and from other reliable published sources.
Alrighty, great. Can you expand a little bit as to why?
Well, the cost approach can provide support for the appraiser's reconciled value opinion and their adjustment logic. Since the cost approach contains information on site value and depreciation, this can help support and validate adjustments taken in the sales comparison approach that addressed items such as age, condition, quality of construction, and site variances.
All right, great. Another question for you, John. Is a mortgage structured by a single wide manufactured home eligible for sale to Freddie Mac if Loan Product Advisor provides a risk class of caution?
That's a non-starter. No, to be eligible for sale to Freddie Mac for a mortgage secured by a single wide manufactured home, to be eligible, it must be an accept mortgage. Many mortgage programs and collateral types have differing requirements for eligibility, And after thorough evaluation, Freddie Mac determined that requiring an LPA risk class rating of accept was appropriate, given this is our initial unrestricted guide offering for this property type.
Okay, great. Another one for you, John. It reads, when needing to convert the manufactured home to real property, some settlement companies or attorneys will require an affidavit of fixture and others a surrender of title. Which one of those is correct?
Well, it's one of those, it depends. It would depend on the state laws of where the manufactured home is located. To be eligible for delivery to Freddie Mac, a mortgage must be secured by a perfected first lien on the real estate that consists of the manufactured home and the land on which the manufactured home is permanently affixed. The manufactured home may be legally classified as real property under applicable state law, including relevant statutes, regulations, and judicial decisions. Now, if state laws and regulations or administrative policies that establish procedures for this, allowing for the surrender and cancellation of the certificate of title, the seller must comply with those procedures. And in some cases, the borrower may have to file an evidence of intent or affidavit of a fixture for a manufactured home to be converted to real property.
All right, great, John. And we did have one from the chat here. It asks, what documentation is acceptable to have in the file to address this requirement for FHLMC?
One more time, please.
Sure, it says section 5703.2 talks about foundation requirements for manufactured homes older than October 20th, 2008. What documentation is acceptable to have in the file to address this requirement for FHLMC?
Okay, that would be for us. The appraisal report would be satisfactory because the year built would be taken from the data plate that the appraiser would include. So that's how we would be able to have that information, and that could be retained in the mortgage file.
All right, great. If we weren't able to answer your question live on air, we'll definitely have a member of our Freddie Mac team follow up with you. But Jessica, I'll pass it back over to you. Thank you, John.
And great information, and thank you so much, John. Next, we're going to turn it over to Stacy for Affordable Seconds.
Thanks, Jessica, and hello to our attendees. Today, I'd like to discuss some changes in Affordable Seconds. Prior to our recent guide update, only agencies that met certain requirements were eligible providers of Affordable Seconds. Credit unions were prohibited from providing the Affordable Second, and community development financial institutions, commonly referred to as CDFIs, were excluded due to their likely participation in the origination process of the first lien mortgage. CDFIs were only eligible to provide funding on a limited basis through a term of business. This update has expanded eligibility to credit unions and CDFIs as providers of Affordable Seconds.
For our audience, please check the chat for a true/false question while Stacy talks us through the changes to seller-funded Affordable Seconds.
So prior to July 5th, the guide only allowed seller-funded Affordable Seconds when the seller was a depository institution with an Affordable Seconds program that supported their Community Reinvestment Act requirements. Now, credit unions that are not subject to CRA requirements are now eligible when they have an Affordable Seconds program that supports their affordable lending and/or mission-focused program. Additionally, certified CDFIs may be the seller and provider of the Affordable Second when the CDFI has an established Affordable Seconds program that supports affordable lending and the credit needs of prospective homebuyers in their market. The first lien must be a home possible mortgage secured by a one-unit primary residence that is also an accept mortgage originated through the seller's retail channel. These updates help to provide additional liquidity to the affordable market, which in turn provides borrowers funds to use for closing costs and/or down payment assistance.
And Stacy, what about our chat question?
The answer is false, as long as the seller of the first lien is not the provider of the Affordable Second. However, if the seller of the first lien mortgage is also the provider of the affordable second, the first lien is limited to home possible mortgages.
Thank you, Stacy. Can you give us an example of how this will benefit borrowers?
Of course, a loan officer employed by a credit union is working with a borrower whose annual income qualifies them for a home possible first lien mortgage. The loan officer has pre-qualified the borrower by submitting the mortgage to a loan product advisor and has received a risk class of accept. The borrower is excited to be qualified, but will have to wait to purchase a home until they can save the money for a down payment and to pay for the closing costs that will be associated with the transaction. The credit union has an established Affordable Seconds mission focused program that was developed to support its members. The loan officer reviewed the requirements of the Affordable Seconds program and the borrower is eligible. The borrower can now go house hunting as they no longer have to wait to save the money, as the lender they are working with can also provide the funding for the down payment and closing costs through their Affordable Seconds program.
All right, great. Thank you so much, Stacy. We'll now ask you a couple questions here. The first question for you is, does the affordable seconds have to be forgivable?
No, the Affordable Second may be repayable or forgivable.
Okay, great. Next question for you, can an affordable second have a required balloon payment?
Unfortunately, no. The Affordable Second must not require repayment in full prior to the first lien mortgage.
Great. Looking around here to see if there's any additional questions. Just a reminder, I know it's come through the chat a few times, but everyone will receive a copy of the presentation today as well as the recording. So no worries about jotting down content quickly there. But in the interest of getting back to our speakers here, we'll make sure that everyone has questions to follow up, or a Freddie Mac team member to follow up with you for questions that we did not answer live today, just to make sure we have all of the correct answers for you. But I will turn it back over to our speakers.
Thank you. And as a reminder, for any additional information, we encourage you to take advantage of the trainings and resources available from the Freddie Mac Learning Center. And the customer call center provides seller servicer support Monday through Friday at 1-800-FREDDIE.
And please visit Freddie Mac's single family webpage at sf.freddiemac.com and stay current with resources there, including the single family seller servicer guide at guide.freddiemac.com.
That ends our portion of the presentation for today. We hope you enjoyed this webinar and that you found it useful.
And thank you to all of our clients who joined us today. As a reminder, if we didn't get to your question, we'll get back to you directly next week. Thank you and enjoy the rest of your day.
I wanted to take a moment again to thank everyone for joining today's Policy on Point webinar. As a final reminder, all participants will receive a copy of the presentation deck and recording and communication sent to your email after the event. If you would please take the time to answer our 2-question survey as you close out of today's webinar, we would greatly appreciate your feedback. Thank you again for your attendance and your time. Enjoy the rest of your day.